Hey everyone, it's Brian, back with another video. Today, we're diving into a topic that's always sparked debate and intrigue: why the rich keep getting richer. Instead, we're going to break down the actual mechanics behind wealth accumulation, looking at the key factors that contribute to this phenomenon. We'll explore things like compound interest, access to exclusive investment opportunities, and even the power of networks and influence. So, let's get right into it. Now, let's talk about compound interest. It's the closest thing to magic we have in finance. In the simplest terms, compound interest is essentially interest earned on interest. Imagine you invest $10,000 and earn a 10% return in the first year. You now have $11,000. In year 2, you're earning 10% on $11,000, not just the original $10,000. That means your money is growing at an accelerating rate, not just linearly. The more money you have invested, the more that snowball grows. That's why it's crucial to start investing as early as possible, even if it's with smaller amounts. Let's face it, not all investment opportunities are created equal. Some of the most lucrative opportunities are often hidden from the public eye, accessible only to those with significant wealth and connections. We're talking about things like private equity deals, hedge funds, venture capital, investments. These are not your everyday stock market plays. These exclusive investment vehicles often come with higher potential returns, but they also carry higher risks. So, how do the rich get access to these exclusive opportunities? Well, it often boils down to network and connections. If you're a wealthy individual, you're more likely to move in circles where these kinds of deals are being discussed. This isn't to say that all wealthy individuals are privy to some secret society of investment opportunities. Here's a hard truth. Investing always involves some degree of risk. No matter how safe an investment might seem, there's always a chance that things could go wrong. But here's where things get interesting. The level of risk you're comfortable taking can significantly impact your potential returns. Your risk tolerance can shape your entire investment strategy. Generally speaking, higher risk investments have the potential for higher rewards, but they also come with a greater chance of losing money. It's a classic risk-reward trade-off that every investor must consider. Think of it like this. Investing in a well-established, publicly traded company might be considered relatively low risk. These companies have a proven track record and are less likely to experience extreme volatility. Now contrast that with investing in a brand new startup company. Startups are exciting and innovative, but they come with a lot of uncertainties. This is a much higher risk proposition. The startup could either skyrocket to success or fail completely, leaving investors with nothing. The potential payoff could be huge if the company takes off, but there's also a much higher chance that the company could fail and you could lose your entire investment. It's a gamble that not everyone can afford to take. Wealthy individuals are often in a better position to take on higher risk investments because they have more financial cushioning to absorb potential losses. Their wealth acts as a safety net. If one investment goes south, it's less likely to cripple their overall financial well-being. This financial resilience allows them to take risks that others might shy away from, potentially leading to even greater wealth. Let's talk about a concept that's often overlooked when discussing wealth accumulation: economies of scale. This principle plays a crucial role in how the wealthy continue to grow their wealth, often at a pace that far outstrips the average person. In simple terms, economies of scale mean that as you increase the scale of your operations, whether it's a business, an investment, or even just your everyday purchases, you can often reduce your costs per unit. This reduction in cost can lead to higher profit margins and more competitive pricing. Think about it like this. If you're buying a single bottle of water at a convenience store, you're going to pay a premium price. This is because the store has higher per unit costs for smaller quantities. But if you buy a whole case of water from a wholesale retailer, the cost per bottle drops significantly. This is a simple example of how buying in bulk can save money. Wealthy individuals often have the capital to make larger investments, which means they can negotiate lower fees, access better terms, and potentially secure discounts that wouldn't be available to smaller investors. This ability to leverage their financial power gives them a significant advantage. This advantage extends beyond just investments. It can also be seen in the way they manage their businesses and personal expenses. Wealthy individuals can also benefit from economies of scale in their businesses. By operating on a larger scale, they can reduce costs, increase efficiency, and ultimately maximize their profits. This cycle of reinvestment and growth helps them maintain and expand their wealth over time. Let's be real, taxes are a fact of life. But here's the thing, the tax code is incredibly complex, and it's filled with deductions, credits, and loopholes that can be leveraged to minimize tax liability. Wealthy individuals and corporations are often in a better position to take advantage of these tax benefits. It's about legal tax avoidance, using the tax code to your advantage within the bounds of the law. Wealthy individuals often have access to teams of accountants, lawyers, and financial advisors who specialize in navigating the complexities of the tax system. These strategies aren't necessarily secret, but they often require a level of financial sophistication and resources that most average taxpayers simply don't have. Let's face it, managing money effectively is a skill. And just like any skill, financial literacy can be learned and honed over time. Wealthy individuals often have a significant advantage when it comes to financial literacy. If you grow up in a household where money is constantly being discussed, where investing is the norm, and where you're exposed to financial concepts from a young age, you're more likely to develop a strong foundation of financial literacy. This isn't to say that everyone born into wealth is automatically financially savvy, or that those who aren't born into wealth can't achieve financial success. We've all heard the saying, it's not what you know, it's who you know. Wealthy individuals often move in circles where business deals are being struck, investments are being made, and valuable information is being shared. They attend exclusive events, rub shoulders with industry leaders, and build relationships with people who can provide insights, advice, and access to lucrative opportunities. Now, this isn't to say that networking is some sort of exclusive club for the wealthy. Building a strong network takes time, effort, and a genuine desire to connect with others. But it's undeniable that having wealth can provide access to certain social and professional circles that can be incredibly beneficial for business and investment purposes. Here's a key difference between how most people earn money and how the wealthy often build their fortunes: passive income. Passive income is money earned with minimal effort. Most people rely on active income. They trade their time for money through a job or salary. This means they have to work continuously to earn. But the wealthy often prioritize building streams of passive income, money that flows in without them having to actively work for it. This can come from investments, rental properties, or businesses that run themselves. Think of it like this. Active income is like filling a bucket with water, one drop at a time. Each drop represents the effort and time you put in. Passive income, on the other hand, is like having a pipeline that delivers a steady stream of water without you having to constantly refill the bucket. It's a more efficient and sustainable way to build wealth. Wealthy individuals often focus on building these passive income streams. They invest time and resources upfront to create systems that generate income over the long term, because they provide ongoing cash flow and allow their money to work for them even while they sleep. This financial freedom enables them to pursue other interests and opportunities. Let's address the elephant in the room: inheritance. This intergenerational transfer of wealth can give some individuals a considerable head start in life, providing them with opportunities and resources that others may have to work much harder to attain. Inheriting wealth doesn't automatically guarantee success. However, it's also naive to ignore the very real advantages that inherited wealth can provide: access to better education, the ability to take risks without the fear of financial ruin, and the freedom to pursue passions without the burden of student loan debt or a mortgage. Economic downturns are a fact of life, but here's the thing: wealthy individuals are often better equipped to weather these economic storms than those with fewer resources. One reason for this is diversification. Wealthy individuals typically have their money spread across a variety of asset classes: stocks, bonds, real estate, private equity, you name it. This diversification helps mitigate risk because if one asset class takes a hit, their entire portfolio isn't wiped out. Wealthy individuals often maintain significant cash reserves, which provide a financial cushion during tough times. And there you have it, the 10 key factors that contribute to why the rich get richer. The goal here wasn't to make anyone feel discouraged or to imply that the system is rigged against them. Instead, my hope is that by understanding these factors, you can gain valuable insights into how wealth is built and leverage some of these principles to improve your own financial well-being. If you found this video helpful, don't forget to give it a thumbs up and subscribe to the channel for more content like this. Thanks for watching.